Global capital expenditure on artificial intelligence infrastructure and development is projected to hit an astounding $2.59 trillion by 2026. This diverging bar chart maps that massive $2.59 trillion input against its actual corporate return. Down here on the output side, we see that 80 to 95% of enterprise AI deployments are currently yielding zero measurable impact on profit and loss, with only 6% of organizations capturing significant value. Look closer at the deployment data, and the operational friction is obvious. Forecasts indicate 40% of agentic AI projects will be canceled by 2027, and 54% of the workforce is already fatigued. This severe disconnect between macroeconomic spending and microeconomic reality forces a question in financial economics. Are we witnessing a speculative mania, or the rational capitalization of a general-purpose technology? We have seen this exact paradox before. During the late 1990s dot-com boom, internet protocols and e-commerce were genuinely transformative, yet the financial assets tied to them were dramatically overvalued relative to their eventual cash flows. To evaluate current markets accurately, we must stop treating AI as a single, uniform asset class. It is a multi-layered ecosystem, and the economic reality changes depending on which level you analyze. We can divide this ecosystem into a structured stack, starting with base hardware, then physical infrastructure, next foundation models, and finally enterprise applications. Asking if AI as a whole is a bubble is analytically useless. Institutional survival in this market requires discarding binary thinking and performing a forensic, layer-by-layer valuation diagnostic. This graph visualizes residual exuberance. The bottom line is the baseline fundamental valuation. The top line shows market price spiking upward. The gap is price unjustified by future cash flows. To be sound, this upper region requires persistent revenue growth and appropriate risk discounting. When we apply this asset pricing methodology to the foundational layer of the AI stack, semiconductors and cloud computing, we find measurable fundamental support. Hardware manufacturers are currently capturing bottleneck rents. They have massive realized revenue, extreme gross margins, and a product that is physically scarce. But their primary vulnerability lies in customer concentration. The vast majority of this demand comes from a small cohort of hyperscalers and frontier model developers. This creates a localized bubble risk. If hardware buyers double order chips to avoid shortages, suppliers experience a temporary revenue spike. If the market misprices that panic buying as permanent durable revenue, the valuation detaches from reality. The cloud platform operators buying those chips occupy the next layer up. They hold massive balance sheets and structural distribution advantages across the enterprise sector. Their specific risk is defensive capex. Cloud providers are spending billions on AI infrastructure simply to preserve their existing market share and workloads, rather than generating high incremental returns on that invested capital. Conclusive. The hardware and cloud layers possess genuine cash flow support, but their valuations become fragile if the market permanently capitalizes short-term scarcity and defensive spending. Beyond silicon and software, AI is a heavy industrial build-out, constrained by physical infrastructure. The International Energy Agency projects that data center electricity consumption will double by 2030, creating severe bottlenecks in power procurement and grid interconnection. For investors funding this physical expansion, the primary hazard is a concept known as asset life mismatch. This dual timeline diagram maps the mismatch. The top timeline shows a data center financed with a 20-year capital commitment. The bottom timeline shows GPU architectures reaching obsolescence in 3 years. If hardware requirements change, the facility becomes obsolete, trapping the committed capital. We saw an identical physical overbuild during the telecom fiber crash of the early 2000s. The fiber optic cables in the ground were ultimately highly useful, but the initial financing structures collapsed. The physical layer of the AI stack risks repeating this cycle. The technology will likely succeed globally, while the initial infrastructure investors are wiped out by depreciation errors and timing miscalculations. Moving higher up the stack, we reach the foundation models. These systems hold clear strategic importance and have achieved exceptionally rapid consumer adoption rates. However, the private markets funding these models obscure their unit economics. Trading frontier models requires billions in upfront capital, and running inference on them burns cash with every query. They also face a dual threat to their pricing power. the rapid commoditization of AI capabilities, and the proliferation of highly capable free open-source alternatives. Above the models sits the deployment layer, applications and agentic AI, where enterprise value is supposedly realized. Here we find a harsh paradox. While 88% of organizations use AI, 40% of autonomous agent projects will be canceled by 2027. Data from MIT and the Rand Corporation indicates these failures rarely stem from the AI models themselves. Instead, deployments collapse due to a lack of AI-ready internal data and weak systemic integration. This graph models the productivity J-curve, mapping aggregate productivity dropping into a trough of integration before climbing past the baseline. Right now, enterprise AI is stuck at the bottom. Workers are bogged down managing AI hallucinations, directly causing the massive user fatigue we observe. Lightweight model wrappers, applications built on top of external APIs with low switching costs and no proprietary data moats, do not have the structural durability to survive this integration trough. The application and model layers are exhibiting severe, narrative-driven bubble dynamics. They are heavily overcapitalized relative to their current ability to capture actual enterprise surplus. To separate the durable technological build-out from the speculative bubble, we need a systematic, multi-pillar diagnostic framework across the entire AI ecosystem. This flowchart categorizes our required inputs. A clinical diagnosis requires filtering every asset through fundamental cash flow analysis, explosive price dynamic testing, and CapEx sustainability metrics. Running the 2026 AI market through this pipeline reveals a bifurcated reality. Hardware and physical infrastructure push towards a build-out output, while applications and models get sorted into a bubble risk output. This matches historical precedent. Just like the railroad and electricity network expansions, we are in a financially exuberant installation phase. The boom is concentrated in the hardware, compute, and power layers. They represent a genuine, durable technological revolution, supported by real physical scarcity. The bubble is downstream. The application and undifferentiated model layers are highly speculative, priced for perfection but delivering thin, easily contested margins. For enterprise leaders and investors, the strategic imperative is clear. Pivot away from generic AI software and focus entirely on rigid, proprietary data-ready integration pipelines. Long-term capital will only flow to entities that control the compute layer, or those that possess defensible, heavily integrated enterprise workflows. Artificial intelligence is a permanent macroeconomic transition, currently masked by localized financial hysteria. Navigating it demands clinical asset pricing, not